Hey everyone, welcome back to Corporate Decoder, the place where we decode the often confusing world of corporate filings. Today, we're diving into Archrock's latest proxy statement. It's a bit like reading tea leaves, but instead of soggy leaves, we're sifting through legal jargon to understand what's really going on. Will Archrock keep powering forward, or will some hidden clause trip them up? Let's find out. Archrock is gearing up for its annual stockholders meeting. It sounds like a snooze fest, but these meetings are where big decisions get made. Think of it as the company's version of a town hall, except with more suits and potentially higher stakes. The main event, voting on who gets to sit on the board of directors, basically the company's oversight committee. Think of it like a school board with way more power. Plus, stockholders will weigh in on Archrock's accounting firm and executive compensation. It's all about accountability and ensuring the company's leaders are aligned with the owners, the shareholders. The board is urging everyone to vote for their nominees and proposals. It's pretty standard. Companies usually want things to go their way. What's interesting is seeing if there will be any dissenting voices, any stockholders who think Archrock is heading in the wrong direction. Let's look at the nominees. There are 9 people up for election, with the company highlighting gender and racial diversity. Anne-Marie N. Ainsworth and Frances Powell Hawes are highlighted, plus other directors with vast experience in gas, finance, and capital markets. We will later discuss whether that is enough or not. Director independence is a big deal. It ensures that the board isn't just a rubber stamp for management. 7 out of the 9 nominees are considered independent. These are the folks who are supposed to look out for the shareholders' best interests, not just the CEOs. Tenure on the board is always a hot topic. The company believes they have a good mix. Too much time and directors might get complacent. Too little and they might not have enough experience. It's a balancing act. The board does an annual self-evaluation. They fill out a questionnaire to point out the board and committee's strengths and weaknesses. They also changed internal processes to distribute materials more timely. During the past year, Archrock's senior management team members attended meetings with investors to discuss their strategy. They also initiated outreach to their top stockholders representing over 70% of their shares. This gave a chance to management to learn what they found important and explain their point of view. After hearing feedback from certain investors, they have provided more information on director onboarding, board, and committee self-evaluations. Now let's talk about related party transactions. This is where things can get a little murky. It's about making sure deals are fair and above board and not just benefiting someone on the inside. The audit committee makes sure all related party transactions are in Archrock's best interest. They have a director who is also affiliated with one of their customers, Hillcorp. In fiscal year 2024, Archrock did about $41.7 million in business with them. This is allowed, but it's heavily scrutinized to avoid any potential conflicts of interest, making sure things remain fair. How much do the directors themselves get paid? The chairman gets extra, and so do the heads of the audit, compensation, and governance committees. The company also awards each non-employee director restricted stock. The goal is to align their interests with those of the stockholders, so the board members are incentivized to make decisions that will drive up the stock price. The company aims to pay their board members near the median of their peer group. Their stock ownership policy requires each non-employee director to own an amount of the company's stock equal to at least 5 times the base retainer amount. Risk oversight is another key area. The board has a big role in making sure the company isn't taking on too much risk, including cybersecurity risks. The company has their vice president of IT and senior manager in charge of IT security provide regular cybersecurity updates to the audit committee. Let's take a look at what they have to say about their independent auditor and some key financials. The audit committee is recommending Deloitte to continue as their independent accounting firm. For 2024, Archrock paid Deloitte $1.8 million in audit fees. All services performed by Deloitte were pre-approved to avoid any conflicts of interest. The audit committee recommended to the board that the audited financial statements be included in Archrock's annual report on Form 10-K for the year ended December 31, 2024. How about executive pay? A big chunk of executive pay is tied to performance, especially the stock price and key short-term goals. They must own a lot of stocks, be on the hook for clawbacks, etc. The goal is to reward performance with a mix of fixed and variable pay. The potential cash payout ranged from 0% to 200% of their incentive target. The program is designed to create a focus on the overall success of the company. In 2024, the Compensation Committee approved base salary increases to better align with the market for their respective roles. The biggest increase went to the Chief Financial Officer, Douglas Aaron, with a 7.3% bump. One key metric that leaders are paid on is adjusted EBITDA. The adjusted EBITDA for 2024 was $595 million. The company is also placing a high priority on sustainability. They became one of the leading providers of electric motor drive compression equipment with the TOPS acquisition. After all this review, it is time for an analysis. This proxy statement paints a picture of a company that is performing reasonably well. Revenue is strong, and executives are being rewarded for their work. Also, with the help of management, Archrock is positioning itself well in this new era of more green initiatives. The big question is, are these executives truly aligned with shareholders, or are they just padding their own pockets? This question is hard to answer, because it is up to shareholders to participate and hold the leadership accountable with their vote. As for downsides, the related party transaction is something to watch, though there is little that investors can do if the transaction follows the compliance requirements. Any potential conflict of interest, or even just the appearance of one, can erode trust and damage the company's reputation. Thanks for tuning in to Corporate Decoder. I hope this has helped you make sense of Archrock's proxy statement. Remember to like, subscribe, and hit that notification bell so you don't miss our next deep dive into the world of corporate filings. Until then, stay curious.